Have you ever wondered where money actually comes from? Most people think it's the government, printing stacks of cash in a giant factory. And while that's partly true for physical currency, it's only a tiny piece of the puzzle. The vast majority of the money in our economy, the digital numbers you see in your bank account, isn't printed at all. It's created by commercial banks, seemingly out of thin air. How is this possible? Is it some kind of magic trick? Stick around, because today we're pulling back the curtain on one of the most misunderstood concepts in finance: how banks create money. Let's start with a common misconception. You might think that when you deposit $100 into your bank account, the bank takes your physical cash, puts it in a vault, and just keeps it safe for you. Then, when someone else needs a loan, the bank lends out that same $100. It sounds logical, right? But that's not how it works. That's more like a storage locker, not a modern bank. In reality, your deposit is just the beginning of a fascinating process called fractional reserve banking. So, here's the real story. Imagine you deposit that $100. The bank doesn't just lock it away. Instead, regulations require them to keep only a fraction of that deposit in reserve. Let's say the reserve requirement is 10%. This means the bank has to hold on to $10 of your money. But what about the other $90? The bank can lend it out. Now, let's say someone, we'll call her Sarah, comes to the bank and takes out a $90 loan to buy a new bike. The bank doesn't hand her a stack of cash from its vault. Instead, it simply credits Sarah's bank account with $90. And just like that, new money has been created. Your original $100 is still in your account, showing as a balance you can spend. And now, Sarah has $90 in her account that she can spend. The total money supply just increased from $100 to $190. And the $90 deposit is a liability for the bank because they owe that money to Sarah. It balances out on their books, but the story doesn't end there. This is where it gets really wild. Sarah buys her bike from a shop owner named Tom. Now, what does Tom's bank do? You guessed it, they follow the same rule. They keep 10% in reserve, which is $9, and they can lend out the remaining $81. Again, the bank just creates an $81 deposit in David's account. Now, let's tally it up. Your original $100 is still there. Sarah's $90 deposit created a loan. The total money in the economy is now your $100, plus Tom's $90, plus David's $81. That's $271, all created from your initial $100 deposit. This process continues. David spends his $81, the recipient deposits it, their bank keeps 10% and lends out the rest. Each time a loan is made and deposited, new money is created, though in smaller and smaller amounts. This ripple effect is called the money multiplier. Theoretically, with a 10% reserve requirement, your initial $100 could eventually lead to the creation of up to $1,000 in the broader economy. The formula is simple. The initial deposit divided by the reserve requirement, so $100 divided by 10%, or 0.1, equals $1,000. Now, you might be thinking, this sounds kind of risky. What if everyone rushes to the bank at the same time to withdraw their money? This is called a bank run. And it's a legitimate concern. If everyone demanded their cash, the bank wouldn't have it because most of it has been lent out. This is why we have central banks, like the Federal Reserve in the US, which act as a lender of last resort to provide liquidity to banks in a crisis. Also, government programs like deposit insurance guarantee your money up to a certain amount, which gives people confidence in the banking system and prevents widespread panic. In the United States, the FDIC insures deposits up to $250,000 per depositor, per bank. This system of money creation is the engine of our modern economy. It allows capital to flow to where it's needed most. It funds mortgages for families to buy homes, loans for entrepreneurs to start businesses, and credit for individuals to make purchases. Without this ability for banks to create credit, economic growth would be incredibly slow. Imagine if you had to save up the full price of a house in cash before you could buy it. Most people would never become homeowners. Bank-created money makes these large-scale investments possible. However, This system isn't without its critics. One major point of debate is inflation. When banks create a lot of new money through lending, it increases the overall money supply. If the supply of money grows faster than the supply of goods and services, it can lead to prices going up. Central banks try to manage this by adjusting interest rates. When they raise rates, borrowing becomes more expensive, which slows down lending and money creation, helping to cool down inflation. When they lower rates, it encourages borrowing and stimulates the economy. It's a delicate balancing act. Another concern is financial stability. The process of creating money through debt can lead to economic bubbles. If banks lend too aggressively for, say, real estate, it can drive prices up to unsustainable levels. When the bubble pops, borrowers default on their loans, and banks can face massive losses, potentially triggering a financial crisis, like the one we saw in 2008. This is why banking regulations are so crucial. They're designed to ensure banks lend responsibly and maintain enough capital to absorb potential losses. It's digital credit created by commercial banks every time they issue a loan. It all starts with a deposit, which allows the bank to lend out a multiple of that amount through the fractional reserve system. This process, known as the money multiplier, fuels economic activity by making credit available for businesses and individuals. While it's a powerful engine for growth, it also comes with risks like inflation and financial instability, which governments and central banks work to manage through regulation and monetary policy. The next time you look at your bank balance, remember that those numbers are part of a massive, intricate, global system of credit and debt. It's not cash in a vault. It's a digital promise, a record in a ledger that was likely born from a loan. It's a fascinating, and sometimes controversial, system that shapes our entire world. Thanks for watching. If you found this explanation helpful, give this video a thumbs up and subscribe for more deep dives into how our world really works. And let me know in the comments, did you know this is how money was created? See you in the next one.